Even though we face the difficulties of today and tomorrow, I still have a dream. It is a dream deeply rooted in the American dream.
Till I hear you at the door, until you're in my arms once more, Saturday night.
Yes, the torch of Lady Liberty symbolizes our freedom and represents our heritage, the compact with our parents, our grandparents, and our ancestors. It is that lady who gives us our great and special place in the world.
Let us not just believe in the American dream, let us be worthy of it.
Starting with the American dream, we live in a very unique country with a rich and storied history. But when I do look forward to the future, I do ask the question, what is next for the American dream? I'm going to start this story with a picture of my grandmother. Her name was Pearl. I never met her. She passed away a little bit before I was born, but she was really a very revered person in our family, really loved by her grandchildren and her children, who still tell stories about her today, to this day. She grew up in Russia during the Bolshevik Revolution. Her family owned land. They were farm owners. But during that time, land ownership was prohibited. So she remembers literally in the middle of the night, she was 7 years old, hiding under haystacks with her mom and her 4-year-old sister while soldiers pillaged their family farm. The last she remembered from her grandmother was she had to say bye to her grandmother. Her grandmother implored them to leave because she was frail and couldn't keep up the pace of their escape. 5 long years it took them to get to America. Long stints in Romania, Egypt, Canada, but they finally did make it to America. And this is what she thought, AI enhanced. This is what she thought America was going to look like. She literally thought, from the stories she was told, that the streets of New York would be paved with gold. She was obviously disappointed when the reality didn't match it, but that's how grandiose the American dream, the vision was for her. That being said, she cherished throughout her life the memory of coming to Ellis Island, seeing the Statue of Liberty and the promise of freedom, opportunity, and really safety that it presented for her. I was surprised to learn when I was doing some research on this that the term American Dream was coined after she arrived. It was coined in 1931 by this individual, James Truslow Adams. His book, Epic of America, was an international bestseller, and this was his definition: that dream of a land in which life should be better and richer and fuller for everyone, with opportunity for each according to ability or achievement. It's interesting that he wrote that in 1931. That was the Great Depression. And that was meaningful for him because for him it was more than just material wealth. It had to do with personal growth and equal opportunity too. Fast forward to the 1940s. It's my grandmother again with her husband, my grandfather, her 3 kids. The American dream lived up to its promise for them. My mom there is on the right, sucking her thumb. She graduated UCLA. Her twin sister graduated Berkeley. And again, it lived up to their promise. The kids had levels of success. All 3 of them had families of their own and levels of success that exceeded the levels of their parents. That's what the American dream is all about. What were the 1950s like when my parents grew up? Optimism would be an understatement. It was idealism, utopia, fantasy. We just defeated the axis of evil in World War II. The highway system, was connecting the country. Rock and roll Elvis Presley were thriving, and people were having lots and lots of babies. It was the baby boomer generation. Opportunity was everywhere. Fast forward to the 1980s when I grew up. There I am in the red shirt. That's my older brother, growing up years. Sorry, Mark, he's not here. My twin sister, Jennifer, is in the audience. There's my mom. Little did we know, though, that I have another twin, my dad right there, right? Spitting image. Fate is a very powerful force. I could not, my destiny was unavoidable. what were the 1980s like when I was growing up? Definitely more rooted in realism than the 1950s, but still very much of an optimistic time. My siblings and I knew that if we worked hard, we would achieve levels of success that, again, matched or exceeded our parents. The American dream was very alive for all of us. Fast forward to today, obviously a very different time, right? Idealism has in many ways been replaced by cynicism. The reverence of the nuclear family has been replaced with fascination with scandal and superficial beauty and material wealth. It's just a very different time. Guilty admittance here, I am a little bit of a sucker for The Bachelor. So I do admit that. I do love love stories. But it is a very different time. So with that backdrop, how do people, let's ask the question, how do people think about the American dream? Is it alive and well? So this poll was done in 2010, 15 years ago, where the question was asked, do you still believe that the American dream still holds true? 50% answered affirmative at the time, 15 years ago. That was somewhat of a disappointing result, a lower number than before, but still, half of people said yes. Fast forward to the poll was redone about a year ago. A despondent 27%, basically cut in half. Let's break it down by age group. Not surprisingly, again, back in 2010, the youngest age group, that's on the left, 18 to 29-year-olds, the most optimistic. They had the highest number, as it should be, right? They have their whole life ahead of them. Fast forward to today, a dismally low 21%, right? That's a sad state of affairs. Let's hear what Mr. Common Sense, George Carlin, has to say about this.
It's called the American dream because you have to be asleep to believe it.
It was really hard to find a clip of his without multiple F-bombs. But I was a fan of his growing up. I guess that says a lot about my parents letting me watch George Carlin with his F-bombs growing up. So why such a dismal outlook, though? After all, unemployment's low. We barely had any recessions outside of COVID. Stock market's at all-time highs. Young people are spending $1,000 seeing Taylor Swift. Dodgers are in the World Series. You know, why? That was for all of you. The answer is that many Americans, especially the younger generation, simply feel that they can't keep up. Let's dig into that a little deeper. Let's start with home affordability. I think nothing is more central to the American dream than owning a home and a white picket fence. I'm going to show some stats on this real quick. This chart, don't worry about the details, I'll explain it, but basically what this shows is the average income, household income, going back about 20 years, and it's risen nicely. It was about $45,000 back in 2006, it's risen to about $80,000. But let's overlay that with a line that shows the average income needed to qualify for an average priced home. Starting on the left side, that disconnect there, that was a housing crisis in 2007, 2008. That divergence was so large that literally the global financial system, as we all remember, almost came down. Home prices corrected, homes were more affordable, but look at where we're at now on the right side of the chart, right? That's a pretty dismal state of things in terms of affordability. More young people rent than ever before. They have no choice. And the largest amount of young adults aged 25 to 34 live with their parents and at any time since the Great Depression. It's pretty alarming stat. Credit card debt just keeps going up and up and up, never ending. Interest rates, with higher interest rates, you're paying north of 20% interest rates on that credit card debt. Student loan debt, similar. I don't have a chart for that, but call it 20 years ago, there was about $500 billion of student loan debt. It's quadrupled in 20 years. It's now $2 trillion. It is an epidemic. I was just at a lunch with two lawyers in their 50s. One had just paid off his law school debt. The other one was still paying off his law school debt. And it's a real issue. So when the prospect of upward mobility is lost, what does the hopeless investor do, right? Do they invest and sacrifice for the future? Not really. They might as well enjoy the present. We know all the terms. They're fun terms, right? Songs are made about these terms. Audience participation. What's the term of the day? What's the 4-letter word of the day? Love it. YOLO. You only live once. It's very much of a embraced acronym these days. So what do Americans, especially younger Americans, do? Fly first class, believe it or not. Champagne's free. Right? $1,000 concert tickets. See Tay-Tay. I've never said Tay-Tay in my life. You might as well invite a friend. And credit card debt, you gotta love the perks of credit card points. We actually just had a session on credit card points. The irony of that. Let's get one more from old Georgie.
The only true lasting American value that's left, buying things. People spending money they don't have on things they don't need. Money they don't have on things they don't need. So they can max out their credit cards and spend the rest of their lives paying 18% interest on something that costs $12.50. And they didn't like it when they got it home anyway.
So while the younger generation is more than willing to spend on experiences as opposed to invest, they haven't completely given up on investing. That being said, they feel that life is getting away from them, so they embrace more of a YOLO mindset to investing. What does that mean? They're trying to change their stars quickly. That reinforces more of a gambling mindset or a lottery ticket type like investing mindset. And the financial world at large is more than happy to cater to this. You might have heard of Robinhood, huge company. We all trade on Charles Schwab or Fidelity. Younger people trade on Robinhood. And what does Robinhood do? They gamify investing. You make a trade, literally confetti animations litter the screen. With extra trading, you literally get scratch-off stickers like a lottery ticket where you can win free shares of stock. Robinhood's a platform, if you remember from a few years ago, that whole meme stock craze, GameStop, AMC, things of that nature, that's where it took hold. We don't hear about those anymore because those collapsed. AMC, it was $400 a share a few years ago. Now it's down to $3. It's collapsed 99%. But young people, they're on to the next thing. Robinhood, of course, makes a lot of money on stock trading, but where do they make most of their money in transactions? Options trading, very risky trading, and crypto. Let's spend a little time talking about crypto. So as a starting point, we are not, and I am not a hater of crypto by any stretch. I believe Bitcoin has utility and will likely stand the test of time. Gold, as all of you know, happens to be our vehicle of choice to protect against debasement of currencies, but more to come on that. But again, I think Bitcoin has utility. That being said, most of the rest of crypto is, pardon my French, an utter joke. How many cryptocurrencies have been created in the last, call it 15 years? It's an astounding number, 37 million. 37 million cryptocurrencies have been created. If something can be created so easily, obviously it doesn't have anything of real value associated with it. Now, of course, most of those are worth zero. So how many of them actually trade in the marketplace? 18,000. There's only 12,000 US stocks that trade. I'm including pink sheets, over-the-counter stocks. Only 12,000 stocks, yet 18,000 cryptos trade. Again, though, still, most of them are worthless, or worth very little. How many have a value of over $1 billion? It's a big number, $1 billion. 81. I had no idea. I was doing research. I don't know. I would have guessed 5, 10, I don't know. You don't know the names of most of them. I'll show the names of some and you'll recognize some, but Pudgy Penguins, Avalanche, 13 billion. I'd never heard of it. Pump Fund. Let's dive into one that many have heard of, Dogecoin. Dogecoin was literally created as a joke by its developers. Its developers about a decade ago were mocking those fanatics of crypto that thought crypto was going to take over the world, right? But little did they know that it was going to take on a life of its own, and it grew to about $80 billion in value. It's come back to earth, 37 billion as of late. 10,000 Dogecoin are created every minute. Talk about a printing press, that's 14 million a day. I don't understand why people value it to the tune of 37 billion, but that's the state of affairs we're in today. What crypto presentation is viable without Fartcoin. For those of you that haven't heard of Fartcoin, it is a real coin. It didn't quite make the $1 billion mark, but it's worth, a few $100 million. To some degree, the sillier the name, the more opportunity for a young investor to make a quick buck. We've been here before, nothing new under the sun. We go in cycles, right? Speculative cycles, booms and busts. 1920s and the dot-com boom of the 1990s are great examples, right? Where again, we had booms, speculative fervor, but then obviously collapses. I would say that the difference, though, that I believe with those times versus today is those times were filled with optimism. Irrational optimism, but optimism nonetheless. Again, hearkening back to the data on the American dream, I think many, especially younger people, are very cynical. The more meaningless the vehicle, the better. As long as it's a crypto with a silly name or AI in the title, they're going to jump right in and try to make a quick buck. So how did we get here? How do we get to a place where affordability is out of reach, home affordability, again, in the younger generation just feels like upper mobility is hard to come by, and again, feels out of reach. It's our policies, plain and simple. Going back to 2008, our policies have been incredibly reckless. I'm talking about money printing galore. All of the Morton clients, you've heard me, Meghan and I talk about this, probably like a broken record. Money printing galore, interest rates, 0% interest rates. That's the lowest interest rates in human history. This was not moderate levels of low interest rates. It was extreme levels. And then debt, ever increasing debt with each passing year. What did that do? Of course, it stimulated things, but it made asset prices, homes being a great example, out of reach, especially for the younger generation. The challenge with these imbalances is there is no free lunch. I'm going to dive into one imbalance in particular that I think is the most important that we should be discussing. Our debt levels. We've talked about our debt levels a lot over the years. It's nice that the media is finally starting to talk about this, but the problem is I believe it's a little bit too little too late. So we have $37 trillion of debt, US government debt. To put that in context, in 2007, right before the crisis, we had $9 trillion in debt. It took our country over 200 years to amass $9 trillion of debt. We quadrupled it in 18 short years, right? We are mortgaging our future. That being said, who can wrap their head around what these numbers even mean? What is a trillion? So we played this game before. Some of you may have seen it. But just to give a sense of how gargantuan a trillion is. How long is a trillion seconds, right? 60 seconds in a minute. If you had to count to a trillion, it took you a second to count each digit. How long would it take you to count to a trillion? Any takers for 3 years? Any brave souls? You guys, smart audience. 30 years? A few. 300? So everyone's 3,000? Hands in the room? So most of you might be holding out. I am disappointed in all of you who raised your hands. You fell for my trap. It's 31,709 years. A trillion is a really big number. Hard to comprehend, and we have 37 trillion of debt. I'm not sure if that even helps, though. I can't even still wrap my head around it. So let's break it down to the average taxpayer. How many people in the room are taxpayers? Raise your hand. Yeah, we're all taxpayers, right? So we own a share of this debt. We're American citizens, right? Someone has to pay up at some point. So we each household owes $325,000. That's your share. The average household, by the way, in America makes $80,000 a year. So the average household makes $80,000 a year, owes $325,000. That's their share of debt. And by the way, this number is increasing by $20,000 a year. That's what our deficits amount to. Now, one minor side note, this number, the 37 trillion, does not include Social Security, or Medicare. A lot of estimates on what that amounts to, the unfunded liabilities. On the low end, 75 trillion. On the high end, 200 trillion. Let's pick the low end just to be conservative. Let's say 75 trillion. In essence, what does that mean in terms of how much each of you owe? $1 million. I know you came to this symposium thinking you were going to get tips and tricks on how to make more money. I just made all of you $1 million poorer. So, I don't know if any of you have been to a $1 trillion party, but they're a lot of fun. Of course, these stimulative measures have, increased speculation, increased asset prices, but the concern is, long term, the more vodka we add to the punch bowl, and we're doing it, we're continuing to do it, the bigger the hangover will be. And I would posit that we've already had some mini hangovers along the way. Part of it is this presentation. The fact that the younger generation, only 21%, believe that the American dream is alive and well for them, that is one hangover that is real. We haven't even really talked about inflation. Inflation that really picked up, call it 4-ish years ago, prices are much higher than they were 4 years ago. That's another mini hangover that we had. The concern is that the longer we pursue these policies, the bigger, again, the ultimate hangover will be. So, as we're getting close to the end here, what is our approach from an investment point of view? When you have rampant speculation on the one hand, but it's countered by these just tremendous imbalances that we have to deal with at some point. I write a newsletter that hopefully many of you read. It's called The Healthy Skeptic. And I know Morton clients share in this Healthy Skeptic approach. I'm going to break it down for you. I'm going to talk about skeptical first, what it means to be a skeptic, but then with an overlay of a healthy approach to it. Starting when you're skeptical, you're curious, you question things, right? You don't just take the status quo as is. And you're very comfortable veering from the herd. But there's a potential downside with being overly skeptical, right? You can veer into doom and gloom land, fear-based, right? And because you're so smart, right, you talk about all these imbalances that everyone is ignoring, you could develop what is otherwise a crystal ball. You see an end coming with a certain timeline. We reject that sort of hubris. Instead, we have a healthy overlay to our skeptical approach. When I think of a healthy mindset, you're very future-oriented. You embrace challenges. You take them head on and you figure out solution to those challenges, and ultimately you're optimistic. You'll figure a way out of it. We talk about this all the time, Meghan and I, we distinctly have no crystal ball. If someone asks me during cocktail hour what direction the stock market's going in the next year, my answer will be, we have no idea, right? The world's very uncertain. We don't know the timing of things, but that does not concern us. We embrace uncertainty, and our investment strategies reflect that. Lastly, when you think about a healthy lifestyle, think about your diet or workout regimen. What does that look like? You're disciplined, right? It's hard work. There's no shortcuts. Maybe Ozempic is the one mini shortcut. But same applies with an investment approach, right? It's discipline, hard work, and no shortcuts. Contrast that with the YOLO investor, right? Come back to old trusty fart coin. Think of the YOLO investor who's investing in something like that. Are they veering from the herd? Are they questioning things? Are they avoiding shortcuts? I don't think so. In the Q&A, we're gonna talk more about actual strategy, how this comes to life from an investment point of view. But hopefully that was a helpful illustration of our mindset towards investing. In conclusion here, in thinking about the American dream, I'm very empathetic to a lot of Americans, and especially some younger Americans who feel simply like they can't keep up, and that affordability is getting away from them. But when I think kind of farther into the future, I'm more optimistic, and I'm talking about the younger generation. Gets me a little emotional just seeing my family up there, my 3 kids, 12, 14, and 16-year-olds. And when I think about my kids, their cousins, their friends, from all walks of life, to a T, without exception, they are all optimistic. They are. They're up for the challenge. They're resilient. They're really inspiring kids. I'll give one quick example. We all know how competitive college is these days. When I applied to 4 schools. Kids these days now, because of the competitive nature, they have to apply to 15, 20 schools. And I know we parents, we lament that, the opportunity is not the same for them as it was for us, and there's truth to that. Our kids don't have the same mindset. Don't get me wrong. They're not having fun filling out 15 applications by any stretch. but they just have a bring it on attitude. They really do. They're resilient, and I truly am optimistic that they're going to figure out a way to get us out of this mess that to some degree we've created for them. In the meantime, though, we older investors, what are we going to do? We're going to stay patient. We're not going to chase the latest trend, and we're going to continue to diversify and build resilient portfolios that, knock on wood, will march to the beat of their own drummer and be okay no matter which way the economic wind blows. So more to come on the strategy in our Q&A. Thank you for listening, everyone. Appreciate it.
Jeff, that was wonderful. Really, thank you so much for walking us through that journey and ending it on an optimistic note. I suppose we'll get back to a certain level of, a range of optimism to realism. We don't use the pessimist word, right, Meghan?
No, yeah.
If you don't know, Meghan Pinchuk is our Chief Investment Officer and is the reason that you're also rich. Give it a hand, yeah. We can give a hand to Meghan. Meghan, Jeff's had the microphone for a little bit, so I want to start with you on this Q&A. Jeff talks about being a healthy skeptic. I want to get your input on what does it mean to you when you hear that phrase, healthy skeptic. What does that mean to you?
Is this, okay, there we go, great, it's on. And it's funny, Jeff and I, as you alluded to, we talk a lot about this stuff, like a lot, probably too much, but it was awesome seeing that come to life, so it was great. When I think about healthy skeptic, what that means for my role, specifically focused on the investments, I think a lot about stewardship. I think a lot about protecting clients and having a laser focus on risk management. And what I mean by risk management isn't avoiding risk. It's not saying, oh my gosh, this is imbalanced, let's go hide, somewhere and avoid all of this. It's just about understanding the risk, like quantifying it, dealing directly with the numbers and saying, this is reality. And then what are you going to do about it? Where can you invest where you can understand the risk, where you can understand what you're getting paid for taking that risk? Because a lot of these things Jeff was talking about, even though we don't have the timeline on it, it is just math, right? Like these numbers are facts. And so now we know about this. We know this is real. How are you going to position yourself to try and protect against downside, but you still have to live, right? You still have to profit and move forward if things in the economy continue doing well. So we really approach it, I think, with that sort of more intellectual curiosity. We don't have the timeline or the crystal ball. We're trying to say, let's go ahead and be open-minded, but be positioned for anything.
Jeff?
Yeah.
You're a healthy skeptic. You talked about the theme, the mindset.
Mm-hmm.
Can you get into some more specifics? Like, what do we actually do to carry that theory into practice?
Yeah, and hopefully my mic is as good as it's good. As a starting point at More Wealth, we have a long history of really being thoughtful around diversification. And diversification is an overused term in a lot of ways, and in many ways I also think misunderstood. Our industry, a lot of the dogma around diversification was created in the 1950s and 60s from the University of Chicago, and good groundbreaking work, but very limited. Because the way most firms diversify is what they do is they'll add different pieces to the pie. They'll add more stocks to the pie, maybe different sectors, maybe different geographies, and that's all well and good, and we do that too. The problem with that, though, is if you think about the old expression, putting all of your eggs in one basket, all those eggs are just still in one basket. Meaning, when you have an ultimate correction, even though you think you're diversified, all those things move together. So the real work that Meghan and I and the investment team do is finding lots of niche asset classes, a lot of them in the room downstairs, so hopefully you've met with some of them that are truly going to behave differently. So the most simple way to think about it, it's GDP, it's economic growth. Most assets, not surprisingly, do well with a strong economy, roll over with a weak economy. What Meghan and I and the investment team strive to find are investments that will hold their own even if the economy turns south. So that's a big aspect of what we look for. I'll highlight just maybe a few, and then maybe Meghan, you can dive into some of the details. A few of the areas, again, a lot of it's being highlighted downstairs. It's a real focus on real assets, things that we can grab and touch and feel. Second thing is we make loans to companies that fill some sort of societal need. So we believe there's some resiliency with some of that. And then lastly, gold. Gold's been a core position of ours for a very long time.
for a lot of reasons, but the main reason being to protect against the debasement of currencies. So those are three main buckets that I would focus on.
And so it is, again, that includes actually a lot of different kinds of things, but when you start with real assets, as an example, because we do that both on the equity, the ownership side, as well as the lending side, like why does it matter to own something that's real, right? When you own something, we're talking about like housing for families across the country, or a fleet of trucks that are taking goods, across from coast to coast, like these are things you can touch and feel, and there's an intrinsic value to it, right? There's a reason why you look at that. You're like, okay, that's real. This is doing something. It's serving a purpose in society. And you pair that against something like the fart coin with the speculation. And
Thank you for coming back to it.
We'll come back to fart coin over and over again. My kids aren't here to giggle, but I can add it for them. But it's just so it's something you can touch it. Like it makes intuitive sense to us, right? Like, okay, that makes sense. Like why this serves a purpose, this has a function. Necessity-based, similar, the idea being the two main areas we've been focused on are healthcare, as well as food. And so things that everybody needs, right? And so this might be a food company that manufactures canned salmon or baked goods, or healthcare companies that are producing drugs or medical devices to treat cancer or heart disease. And so look, even the millennials, the Gen Xers that you're referring to, like they still need to go to the doctor if they get sick. They still need to put food on the table. So things that everybody needs that we think will really serve a purpose in all types of environments. You want to do gold?
Sure, gold.
After yesterday, you sure you want?
Gold, yeah. I don't know, for those who noticed, man, it's been a straight line up for several weeks. So we were ready for a correction. Boy, yesterday was a big correction, but
today it's fine. Everything's fine.
We'll come back to that. Gold, again, it's our primary vehicle of choice to protect against debasement of currency. Gold typically does well in times of uncertainty, and we definitely live in uncertain times now, so that's been part of it. But the real rationale of why we own gold, it is as a store of value against what we believe these reckless policies. So going back to my presentation, talking about the debt levels, the playbook is tried and true, what the government is going to do. Both parties are doing the same. Sorry if I'm at the risk of offending now everyone in the room. Both parties and the central bank are, when push comes to shove, are always biased towards stimulatory measures. They're always biased towards accommodative measures. Not willing, it's just part of the political process, not willing to take the pain or the medicine that I believe we do need to take to get back to a healthy place. And so when you think about our debt levels, the ultimate solutions are more of the same, right? It's going to be ultimately more money printing, more manipulation of interest rates. And what we're already doing is refinancing our debt with ever increasing levels of debt. Hopefully all of that illustrates and crystallizes the difference between dollars, which is just your paper currency. All of those solutions mean more dollars to fix the problem, versus gold, which can't be printed. It's just two very different things, and gold, as a result, we believe is a store of value to protect against that risk.
You mentioned more and more dollars. It's a lot more and more dollars, but a pretty similar amount of gold or amount of real assets that we talked about. So in talking about real assets, we kind of approach it from multiple different angles, right? And so can you go into how we invest in real assets, equity, debt vehicles, and get into a little bit more specifics on that?
So I think with real assets, we are focused, or have had a large focus on real estate for quite some time. We're all in Southern California. Everyone likes real estate. But housing in particular is one that we like a lot. Certain healthcare assets now as well. I think you see things that are supported by demographic trends, right? So these are real assets, but there's also a real purpose and need for those. The challenge with today is, again, we own quite a bit of real estate, but it's, if everyone was in my session earlier with Grub, like real estate's actually gotten rocked of late. Since 2022, when interest rates went up the fastest they ever have in history, that was really challenging for a lot of aspects of the real estate market, not homes. So if you own your home, you might be like, what are you talking about? Everything's great. But other types of commercial real estate have really taken hits. And the problem is, though, there's a weird imbalance right now between buyers and sellers, where even though prices are down, a lot of sellers are holding on. They don't want to let go at those prices. They're hoping that interest rates come down. So you can't quite go out there and just buy. Ooh, we're at a discount. Let's just go buy. And so we're seeing a lot of opportunities, but we're waiting for, I think, prices to either come down more and see what happens to kind of continue allocating to real estate equity. the thing is, what's nice is when equity is expensive, is that credit is a really interesting way to get access to some of these real assets. So can you lend against some of those same things that we like, that you can touch and feel, that are real, and be in a more secure position and not have to worry about high valuations, as an example. And so we've done lending to a lot of different kinds of companies. Again, real assets. We like to use an example. One of our groups that'll lend against a company. Company's doing well, they got whatever their operations are, but they own a fleet of trucks. And so if that company does well and they perform, they will pay us back at the end of it. That's great. We'll take it. If they don't do well, we're going to go liquidate their fleet of trucks and pay ourselves back. So the idea being that you're now in a more secure position and those assets are backing the investment that you've made, the credit. Same thing on the necessity-based side to some degree is like, again, if you're making loans to some of these companies who have, again, there's like a real need for them, will they be more resilient in environments where, where the economy tanks, right? But people still need to eat, they still need their health care. When you lend against the assets too for credit, ideally you're giving a nice cushion. So you're not just saying, oh, your trucks are worth $100 million. Here's $100 million. You're putting in place a cushion there so that accepting, even if those prices fall and they're down, you still have some coverage. Later, I think on the stage, actually you know the schedule better than me, but White Hawk's going to be speaking, John on, and he was actually at our first symposium ever. Is it the 4th or the 5th?
I think 4th. 4th?
Okay, well, next year, like an anniversary party. He was at the first one way back when, and he was talking about this concept of lending on assets. And he's like, one of the powerful things about their strategies, we're actually agnostic as to what happens in the economy. He's like, I don't worry about it if it does well, if it does poorly. But he's like, I'm also agnostic as to the survival of my borrowing company. Like, they can make it, they cannot. It's going to be the same outcome for me. So it's just really powerful, again, this idea that you're lending against something real. And again, on the credit side, you've got a lot of controls in place. Last thing, because I get excited about this topic. Covenants are really important, and you might hear about that more in the news now because private credit's out there, like in the headlines, and it's as if, oh, this is something scary. There's a big range of these private kinds of loans. The managers we are with,
what do you mean by covenants?
I'm getting there. Okay. Are obsessed with controls, so having like legal controls in place so that if something happens to one of those loans or to one of the companies, they're not performing. It's not just you wait till the end of it and you hope that they turn things around. They can come in real time, go get their assets, go put in, go make them raise cash, put real things they can do to course correct along the way. And so that level of control, I think, is also a really big deal when you're on the credit side. You need to protect yourself.
You've given this a little bit of thought, evidently.
A couple times, yeah.
I want to come back to gold just because, look, I know that gold was corrected a little bit yesterday. It's still up 50% from the last time that we were here a year ago. Yeah. It's pretty incredible. One of the questions that we get a lot is this duality of Bitcoin versus gold. And I know you touched on Bitcoin. The question is, can they coexist? Is there a clear winner? I know you don't have crystal balls, but if you would opine.
Before I'd like to come to that, but if you don't mind, just especially with yesterday, I think potentially people are even wondering our positioning on gold, if it's changed over time. Yeah. And then if we have time on Bitcoin, can we come back to that?
Sounds great.
Is that cool? Do you want to?
Yeah, and related to that, because you got to talk about gold first, so I get to.
Okay, go for it.
So people ask us all the time, do you have a price target? So what's your price? Are you going to sell when it gets to 5,000? What's the number? And the answer is, I would be happy. I love numbers. I'd be happy to give you a price target. If you can tell me how much the government's going to print, I'll tell you what my price target is on gold. And I know it's a little flip, but it's somewhat right. If they print infinity, it just keeps going at this pace. I don't think there's a cap on the price of gold if that happens. And thinking about it even more, 50%, that's a huge number. Gold is not intrinsically worth 50% more than it was a year ago when we met here. The dollar's down, right? It is literally an inverse. This is an exact hedge against the dollar. That's the nature of a store of value, right? Is that gold is just staying the same. It's not going up, but your dollars are going down. That's what actually we're seeing in this price. And so just keeping in mind, the vast majority of us have almost our whole net worth in the US dollar, right? One way or another. So the idea that there's going to be more of a permanent hedge or this gold position in the portfolio, I think makes a lot of sense unless, the government policies change. So.
A little more color on that is we tend to be at Morton Wealth more value investors as opposed to momentum chasers, probably not surprisingly, meaning we like to buy when things are cheap and sell when they're expensive. And so just to be transparent, this run up in gold has made us nervous. Even our long-term thesis has not changed, but for it to be up 50% in the last year, feels like there's some speculative fervor in there. And so what we're doing, and clients have probably seen this in their portfolio, we're being disciplined around, we have a target allocation, and as it runs up, we trim, and then it runs up again, we trim again. So we're being disciplined around that value within a client portfolio, that percentage allocation. But the flip side is a couple of reasons why we still are excited about gold. Two really main ones come to mind. We're so US-centric here in this room. There's the whole world that is buying gold. Specifically, what I'm mainly talking about is central banks. So every country has their war chest, their government. We have our Federal Reserve. What are central banks buying around the globe? They are buying gold hand over fist. Started about 3 years ago to a meaningful degree. They are buying it more than any other asset, and it's not even close. The largest asset that they own typically are US dollars and treasuries. That's their sort of war chest. But they've been net sellers of that in the last few years, and buyers of gold. So that's just, and they're price insensitive buyers, by the way. They're gonna buy whether gold's 2,000, 4,000, or 6,000. So that creates, I believe, a floor under gold. And then one last point I'll make is kind of to use the 1970s as an analogy. 1970s were, we talk about uncertainty now, 1970s were a more uncertain time in a lot of ways. Real high inflation, nasty unemployment. How did investors approach that? What mindset did they have? In that time frame, everything's offense, right? Especially since 2008. Everyone's playing offense. If that ever shifts from an offensive mindset to a defensive mindset, gold, I think, can be one of the natural beneficiaries. So for instance, in the 1970s, people hated stocks because there was a lot of fear and uncertainty. Stocks made about 5% a year annualized in 1970s. That's actually really poor performance because inflation was higher than that. So you lost money on an inflation-adjusted basis in the 1970s. Gold was up 13 times. Literally, your dollar went to 13. And why is that? People crave, going back to Meghan's comments, the investment in something real. They rejected the investments in speculative assets, in the surreal or the virtual, and craved investments in the here and now. Now, I don't want your takeaway being that gold's gonna go up 13 times. That ain't happening, I don't think. If it does, we have bigger problems. But I just wanted to give that even though we're concerned and speculation and there's been a big run up, there's still potential really big upside in gold from here too.
Really real quick. So on Bitcoin, I would tell you what central banks are not buying, and that's Bitcoin. So it's an interesting, again, construct of like having that type of floor or support, right, versus Bitcoin. And
just real quick on that, literally, the only one central bank owns Bitcoin, El Salvador. That's it. So if that tells you the difference. And again, we're not Bitcoin haters. Going back, retail investors, Bitcoin, we always question, is Bitcoin potentially going to supplant gold at some point? We believe that there's room for both, but I just did want to, I'm glad you brought that up with central banks. 0 central banks outside of El Salvador own $1 of Bitcoin.
And look, I think back to with Bitcoin, again, there's a purpose and they can potentially coexist together. I think some of Bitcoin's strengths, though, I think it's not tested, right? Gold, you've got hundreds and hundreds, thousands of years of history on this and it being used as money and it's a store of value. Bitcoin's had, I think it's something like 70% correction since its creation. So it's a lot more volatile. To be a real store of value, there needs to be less volatility. I mean, yesterday sucked, but I think it was down 5%. So
you're talking about for gold.
Yeah, so it's not the same level, right? There's a lot of volatility when it comes to Bitcoin. But look, some of Bitcoin's strengths too, I mean, one of the things is some of its strengths are also its weaknesses. So being decentralized, being off the grid, those types of things that actually are appealing about it. What if you get some type of cyber attacks, right, and the grid goes down? What if you have quantum computing that comes in that can hack it, right? There's all kinds of, we just heard about AI, there are amazing things happening. Like, it has risk to it. There's a lot of unknowns still, even though it is intriguing. One
added risk that I'll mention, again, it goes down to technology. We have, again, I think Bitcoin is it's an elegant solution. I'm intrigued by how it was created. That being said, it doesn't have a long history, so we have more questions than answers. So one example is, can a new coin, crypto, 37 million have been created, can a new one be created that supplants it? I don't know, maybe. Maybe 10 years from now, there's a new technology that we have not even comprehended that combines the beautiful aspects of Bitcoin with maybe some of the transactional elements of Ethereum, and there's a new coin. So what happens to Bitcoin in that environment? Obviously, it's worth less. We just don't know the answer to these things, and it's a lot of it is because it has a limited history.
Whereas gold is an element on the periodic table. Hard to create a new element.
It is.
Possible, but hard. Last question for you guys.
Yeah.
Is you mentioned home affordability in your presentation.
Yeah.
Where are we going from here? Like what that's a pretty big imbalance that
Yeah.
you showed on that chart. Where do we go from here?
Do you want to talk about that? I mean, you hit a little bit on that about supply and demand and people waiting for interest rates to come down, at least on the commercial side.
We were talking about in my presentation with Clay about New York and just like how crazy it was, something like a 500 square foot apartment going for $5,000 a month. And it's just, it's really tough. And again, I think right now too, why prices have been so resilient in Southern California, you have a lot of people with fixed rate mortgages, right? They're not going anywhere. And so the supply has been really limited coming onto the market. I think you're going to have to see, this is where, unfortunately, if you have some type of crash or large adjustment, right, to adjust prices and affordability, it plays into it. Otherwise, you get more of, I think, some of this societal discontent and things that are happening. But AI is going to solve all the problems. So.
Everyone just assumes that interest rates, if assuming they do come down, that home prices will stay up and elevated. One, we have an affordability issue that counters that. But the second thing is, again, to Meghan's point, people have been holding off on selling homes. Can that be an onslaught of supply hitting the market where people now think, oh man, now it's time to sell my home because interest rates are down? Could that hurt prices? Because again, you have an extra supply that's hitting the market.
Actual last question.
No, wait, I'm going to ask my own question. I get to comment on the AI thing, so because we had a couple sessions on that. I know
that was going to be my next question, so there you go.
Well, perfect. I know it's exciting, and the I got overruled because I know the American Dream was great. I wanted to show parts of Terminator so that we could all like make sure we were on the same page about the net end effect of this, because I feel like no one remembers.
Meghan was on that doom end for those who were in the last presentation. She was on the doom part of the AI.
But I think one thing is too, there are things outside of, again, what Jeff mentioned this quickly about Bitcoin, things that we haven't imagined yet. And like, do those have this huge impact on the economy? So even like AI, if the boom is real, right? If the hit to productivity growth, like the upswing of that's real, can that help with some of the debt imbalances? I mean, we've had one of the problems with that debt imbalance is that we've actually had lower slowing growth for many decades now. So does this really drive growth up? And it's possible, right? That could be something. I will say there's negatives too, right? There's the job losses that I think are concern to a lot of people. In addition to that, it feels somewhat like the late 90s in the sense of the CapEx spending, the capital expenditures. These companies are throwing hundreds of billions of dollars at this, and that doesn't mean there's not great productivity to come, but we haven't seen it yet, and that's going to be a lot of productivity to make those numbers worth it.
I'm glad you brought up the late 90s. This is an example. As fast as technology is moving, finance is the one thing that moves faster than technology, right? The 1990s are a great example where the internet was incredible, right? Exceeded our expectations. Despite that, I don't know if you remember the fiber build out that happened. Remember WorldCom, Global Crossing? These were massive companies that built out a ton of fiber. 90% of the fiber went unused, and those companies went away, right? The internet was a success, yet that still happened. The concern is with AI that the same type of build out is happening. You're seeing with OpenAI, the contracts with Oracle and NVIDIA, hundreds of billions of dollars. Astronomical numbers. The numbers kind of truly don't make sense. So the concern is that there's going to be somewhat of an overbuild with regards to this CapEx spending, and there will be a correction. Lastly, maybe to end on a more positive note, because again, AI has been a game changer, and so to Meghan's point, I think productivity, really efficiencies, there's real potential. But again, as we're thinking about other potential avenues in the economy where growth can pick up, healthcare is a great example, as Meghan has alluded to. We spent a lot of time lending to companies in the healthcare space. The advancements in healthcare are phenomenal. They're unbelievable. Cancer technology, gene therapies, you name it. Really new cutting edge technology around aging. Literally all aging really is, I'm simplifying it, but it's basically the deterioration of the DNA in your cells breaking down over time. If there can be breakthroughs on aging, if 80 becomes the new 50, what can that mean? I see some people getting excited. What can that mean for productivity? I mean, utter game changer. Talking about energy. right? We've a lot of more movement in recent years towards clean energy, solar, wind. It's been kind of hit or miss. I think nuclear is a potential game changer. I think it's in inevitability. It's already happening more and more around the world. There's problems with it. There's regulations. There's other issues. But on a pound per square foot compared to any other type of energy, nuclear energy can be an utter game changer from a productivity point of view. I mean, these things can go in many different directions. And so that's why, going back to the punchline of how we invest, we're diversified. We're diversified in a lot of different areas because we don't know which one of these will ultimately take hold.
We appreciate you steering the ship through these choppy waters. Seriously, thank you guys so much for leading our company and for talking to us today.